Welcome to the to Rebel Income Coaching Session 7. Today we're going to put a little bit more focus on dividend-paying stocks, and the reason that these types of stocks are a primary component of the Rebel Income system. Dividend-paying stocks are an often ignored area of the market by most investors, especially those who are a little bit newer to investing and focus primarily on growth investing strategies. That's because stocks that pay consistent dividends tend to be more conservative in most cases than the trendy, sexier sounding stocks riding the latest wave of market fascination and attracting the most attention from market media outlets. The Rebel Income system is built with dividend-paying stocks in mind, specifically because they provide a passive source of income when assignments from a put sale happen. All an investor has to do to receive a dividend is to hold shares on the stock's ex-dividend date, which we'll talk about in just a little bit. Dividends are one of the primary reasons that I often refer to put selling as a gateway to stock ownership in the Rebel Income system. And I like to call dividends specifically the low-hanging fruit of the stock market. Not only do assignments make it possible to own shares in good companies at attractive discounts, but they also activate the passive income opportunities that dividends represent. The most straightforward way to work with dividend-paying stocks is just to buy them and then hold on to your shares. With Rebel Income, we like to add a little bit of our own wrinkle to that reality to make dividends a useful part of a successful value-driven investing method using put selling. First of all, when we sell a put option, we like to make sure to use our strike price as the price at which we view the stock as an attractive value-based buying opportunity. A lot of this is inspired by sentiments that are expressed very well by Mr. Warren Buffett, which I have displayed here on the slide, that it's far better to buy a wonderful company at a fair price than a good company at a wonderful price. The idea here is that we want to differentiate between simply good companies and try to identify wonderful companies, and then identify that fair price as much as we can. If we can determine that a stock is trading at a fair price under current market conditions, then using a put sale, a put selling trade to set up that potential buying opportunity means that we often can use the strike price to set an even better price than what the stock is trading at today, as that possible attractive fair value purchase price. I like to focus my put selling trades on strike prices that are a little bit out of the money, meaning that the stock will have to drop below not only its current price, but also the strike price of the put option that I'm selling in order for me to be assigned and to buy shares in that company. So it's the idea that if I think a stock trading at $50 is an attractive bargain at $50, and I have a I set up a put selling trade that uses a $48 strike price, then I'm setting up the opportunity to buy it at an even better price than what I'm seeing it at under current market conditions. That also means that I don't shy away from accepting assignments. We talked about this a little bit more in the put selling session, but it's worth repeating and making sure to emphasize some of the mechanics behind what happens when you sell a put option. There's a difference between what are called American style options and European style options. With European style options, you cannot be assigned as an option seller You cannot be assigned or have an option exercised against you until the expiration date. Those kinds of options are the exception on U.S. exchanges rather than the rule, and typically apply to stocks representing overseas companies trading that are specifically trading, for example, on European exchanges, but also are listed in the U.S. The vast majority of options that are for stocks listed on U.S. exchanges are American-style options. American-style options simply mean that the option buyer has the right to exercise that option at any point prior to and up to an option's expiration date. When we're talking about put selling, that means that if I have sold a $50 strike price on Tuesday and Wednesday the stock is suddenly at 45 or moving significantly below the strike price that I sold, then I could be assigned that quickly. And in some cases that may happen. The cases where an early assignment prior to an expiration date are the exception rather than the rule. However, it is worth bringing up that they can happen. The more functional reality is that if the stock is below the strike price that you have sold at expiration, you will be assigned if you have not previously been assigned prior to expiration. With Rebel Income and the way that you will see me write about the trades, the way you will see me manage the trades that I write about, you will see that I do not shy away from assignments, whether they occur on the expiration date or even prior to it. Simply because, going back to this first point, thinking about the strike price as a value-based buying opportunity, I'm accepting that strike price represents a price at which I would like to own those shares. But you do have to make sure that you understand what that possibility is and what it means, and what the mechanics may look like. One of the reasons I don't, dividend distributions are one of the primary reasons that I do accept put sales. These are stocks that I want to own, and the fact is I only focus on dividend paying stocks for the Rebel Income system because I want to be able to receive that passive income from stocks that I do purchase as a result of these assignments. A great thing besides the income, the passive income that dividends represent and that they bring in, is that they can also be counted against a stock's purchase price to lower your cost basis. Majority of companies that pay a dividend on U.S. exchanges pay them every quarter, which means that each quarter you get a distribution of cash to your account that you can use for whatever purchase you choose. No matter what you choose to use it for, whether that's to pay your living expenses, to reinvest in the stock, or to allocate that money to investing in other investing strategies or companies, you can count that distribution against the purchase price in your stock. So if I have sold a $48 strike price in the stock that I already mentioned earlier, and I am assigned at $48, and then a month later I receive a dividend distribution of, let's say, 25 cents for the sake of argument, then that 25 cents immediately not only comes into my account, but can also be used for accounting purposes to lower my cost basis from $48 to $47.75. Maybe that doesn't sound like a lot, but over time, especially if you end up holding a company for an extended period of time, say a year or more, then these dividend distributions begin to add up and become a useful part of your cost basis management strategy, and become another way that you can track your net cost in a stock over time to determine how you want to try to manage the position on a long-term basis. Now, keep in mind that when you're selling put options on a dividend-paying stock that you do not already own, you are not entitled to any dividend distributions. Dividend distributions are reserved only for shareholders of record on the record date, which we'll get into in just a minute. The opportunity to receive dividends comes for the put selling in the put selling system that we use for Rebel Income. Those come when an assignment occurs prior to an ex-dividend date, or on stocks that have been previously assigned and held long enough to cover one or more ex-dividend and record dates. So I've been throwing out a lot of terminology here. So let's go ahead and expand what we mean by some of these terms. Dividends are typically declared by a company's executive management team during an earnings announcement. Now, following that declaration, there are a few events that determine who is going to receive a dividend and when it will be paid. So these are the terms I've already used, which we're going to elaborate a little bit more. First, let's talk about the record date. This is a date that is set by a company's board of directors. It is the date that management will compile a list of all shareholders that are eligible to receive a declared dividend distribution. Typically, you will see the record date shown as 1 day following the ex-dividend date. Sorry for the typo on my slide here. 1 date really should be 1 day following the ex-dividend date. The ex-dividend date then is a date that is set by the stock exchange that the company is listed on, the NASDAQ, the New York Stock Exchange, etc. This is the final date that investors can buy a stock and be eligible for a declared dividend distribution. So this is the date, if you care about trying to use dividends for income purposes, that become the most critical and the most important. As an example, if I've been assigned that stock at $48, but before the assignment, let's suppose that even before I placed the trade, management had declared a dividend distribution that would be held on. Let's suppose that today is the 9th of June, and I have just been assigned that stock at $48, and management has announced a dividend that will be that will be paid on a future date. They have set the ex-dividend date for June 12th. That means that June 12th is the last day investors can buy that stock. The next day, June 13th, will be the day that management is going to compile that list of all shareholders that have purchased and continue to own shares as of June 12th. And then finally, we have the pay date, which is the date that all eligible shareholders receive a declared dividend distribution. Now, typically when you see a dividend declaration on an earnings announcement, all three of these dates will typically be shared, but the focus will be on the ex-dividend date and the pay date. The pay date is a date following, obviously, that follows the ex-dividend date and the record date. This may be anywhere from a matter of days to a number of weeks following the ex-dividend date. It is also worth mentioning that as long as you hold shares on the ex-dividend date, you will be eligible for that distribution. That means that let's say that on my $48 stock that I was assigned on June 9th, with an ex-dividend date of June 11th, let's say that later, by the end of the next week, the stock had turned back up, moved above my $48 strike price, and I simply decided to sell it, or to use a covered call trade that I was exercised out of prior to the record date. So that does not mean that I won't receive that dividend distribution, because as a shareholder of record on the record date, I am entitled to that dividend. So even if I don't hold the stock, I still don't hold those shares on the record date, as long as I did hold them as of the ex-dividend date and on the record date, then that distribution is going to come in to me and be deposited in my account by my broker. Okay, all of these then really kind of start to illuminate the reason that I like to call dividends the low-hanging fruit of the stock market. Why do I use this term low-hanging fruit? I'm going to tell a little bit of a story. I grew up in a relatively rural area of Utah. I am not a farmer, but I did spend a lot of time on farms that were owned by the church that I was raised in. These farms are used to provide food and other resources to needy families all over the world. And as an opportunity to provide volunteer service, as well as to teach me the value of work, my parents often took me to work on these farms. A lot of these farms included very large fruit orchards. And when I was young, I wanted to get up on the ladders with my dad and work at the tops of the trees, because that looked like it was a lot of fun. He did not let me do that. He was a lot more intelligent than I was, obviously, and instead he handed me a bucket and told me to concentrate on picking up. He showed me how to identify and recognize fresh fruit that had fallen off of a tree and was sitting on it, that was sitting on the ground, as well as fruit that was within easy reach of my arms at the bottom of the tree on the lower branches. So my job was to gather that fruit at the lower ends of the tree that had fallen on the ground, or was within the reach of my grasp from the ground, from those bottom branches. I quickly began to understand, especially when I became older and I was allowed to get up on those ladders and pick fruit at the upper reaches of those trees, I began to appreciate how much easier the work was to do, working with the low-hanging fruit of those trees. Not only that, but I also have a healthy respect for heights, and so working at the top of these ladders, at the tops of these fruit trees, also made me want to get back down on the ground and continue to work with these lower hanging fruit. Well, that's a long story short. I enjoyed while the opportunity to learn the principles of work related with those later in my life as an adult and as an investor, and trying to refine and develop my own investing system, I began looking for the ways that made the most sense to generate practical income, and to try to identify where I might be able to recognize an easy advantage as an investor that others were generally not paying a lot of attention to. The more research that I did, the more practice I did with my own investing systems, the more I began to recognize that while there were a lot of dividend-paying stocks in the market, there was not a lot of conversation being had about the value of including them in a long-term investing plan that was designed to increase wealth. Most, especially if you are a younger investor, most investment advisors or mutual funds will place focus on growth-oriented stocks, generally, most of which that do not pay dividends at all, and try to put the onus for wealth accumulation on stock price appreciation. Well, in order to own a dividend, if all you have to do is buy the stock and hold on to your shares, then it makes sense that that dividends are a largely underappreciated element of the stock market that that too many investors are not paying attention to. That is one of the major advantages of the Rebel income system, is that we are putting a focus on these stocks that that do pay dividends as an additional element of generating practical returns, useful income that we can use in whatever way we choose. No matter whether your objective is to generate income that you can live on or to reinvest those proceeds so that you can achieve a long-term wealth generation, dividends become an easy passive resource that I believe should not be underestimated or underappreciated, which is why I call them the low-hanging fruit of the stock market. Okay, now it really sounds great to say that when you buy a dividend-paying stock directly from the market or by assignment from a put sale, you get to enjoy the dividend distributions that come with them. The part that also is very necessary to recognize is that when you use put selling in downward trending stocks, those trends can and sometimes do push the stock well below your assignment price. I'm not saying that this happens frequently, but it does happen. It certainly happens with the Rebel income system, and you have to be willing to recognize this reality and to decide how you want to try to manage your system around it. A current example that I have on my track record in my account is Walgreens Boots Alliance. This is a company that that I was assigned shares of more than a year ago, now almost a year and a half ago. And I'm sorry, this is a typo. I say 2/02/2023. The assignment actually occurred in 2022. So on February 18th, 2022. The assignment price, the stock that I purchased my shares in at the time was $49. As of June 9th of this year, the stock is now down at $31.42. In other words, I've watched the stock decline by more than 56% since that assignment. Let me change to show you a stock chart to illustrate what I mean. Okay, here is Walgreens Boots. I can expand my window a little bit so that I can show you the price ranges that we're working with. As of the close of the market on June 9th, the stock is trading a little bit below $31.50, as we can see. My assignment in this stock, as I mentioned, came at $49 in the early part. Excuse me, the initial trade was placed in the early part of February when the stock was up here around the $50 range. And so my put sale occurred with a $49 strike price. So it's a trade that lasted about 3 weeks. Following this put sale, the stock quickly dropped. The assignment happened roughly around in this range when the stock is now down around $45. So by the time I was assigned, the stock was already $49, or excuse me, it was already $4 below the strike price that I had sold. I accepted the assignment because $49 was an attractive price from a valuation standpoint at that time. I have watched the stock extend that decline. Since then, we can see the downward trend that bottomed here in October of 2022, down around $30. After a temporary rally, it has dropped back again and revisited this same level just last month. It has since and into the beginning of June has rallied back up again, is a little bit above here now down at this 31.42 level, but it is still significantly below the $49 strike price that I was assigned. Excuse me, these are kind of ugly, but what we're seeing then is a big difference between the price that I was assigned at and the price that the stock is at now. I'm still down by more than $17 per share from that original purchase price. Now, that is a functional reality that I am continuing to acknowledge, to accept, because Walgreens is still a company that with a wonderful fundamental profile and a value proposition that I still see as being well above the $49 strike price that I was assigned. I am reading the downward trend as a reflection of broader economic concerns that are impacting not only this company, but also drugstores and the healthcare sector in general, and that are reflected in this company's industry and in more than one stock that it competes against. That means that the value proposition now is even better than it was when I originally placed my put sale. But it also means that that as long as I believe that value proposition is placed, as long as I believe that the fundamentals of the company are still in place, my preference is to go ahead and continue to hold the stock. The other reality is that since that assignment, I have been able to take in dividend distributions, 1, 2, 3, 4, 5 dividend distributions since that original assignment, each of which have been able to help me to lower my net cost basis from about $49 to a little bit below 47. When I consider the cumulative impact of those dividends, along with the income that I brought in from that initial put sale, that makes my purchase price look a little bit better, since my net cost basis is a little bit closer to the stock's current price. But the reality is that I'm still more than $15 below the stock's current price, even with that cost basis factored in. So this is a reality that you have to be willing to acknowledge. I am not saying that you have to decide that you are going to follow this in exactly the same way that I do. You may decide that if you take an assignment, you're going to look for opportunities to stay in the stock only as long as it remains close to your assignment price. Some of the people that we work with decide that they are going to sell. That they will set a stop loss, for example, on a stock from a put assignment at 15 to 20% below their current assignment price, and that's a practical way to think about loss management and to minimize losses in stocks that may retreat into extended long-term trends like the one that I am demonstrating to you. And if that is your preference, then I will not criticize it. It's a reasonable approach if you prefer to free up your capital and to look for other opportunities. Other members of our group have used stocks in these situations and factored in some of the income generating components of the options market and option selling to sell covered calls against those shares in the downward trend. Covered calls can be counted in the same way as a put sale as a way to lower your net cost basis over time. And the idea being here is that if you're selling a covered call in a stock in a downward trend, then the the covered calls should generally expire worthless. You hang on to your shares, and the income from the covered calls simply allows you to continue to lower that cost. So let's suppose that after my initial assignment, I sold a covered call. Perhaps here at about 46 at this point. Here's a covered call, one perhaps. That maybe that trade only lasts for a couple of weeks. The stock continues to drop, and that covered call expires. I sell another covered call around this level. So we'll call this covered call 2. And maybe there's a little bit more time, and so by the time that covered call expires, it has again dropped below that covered call price, and so it expires as well. I continue. Let's suppose that I do it here. Here's another covered call. We'll call this covered call 3. All of these are all of these are examples only as opposed to real trades. But in this case, let's suppose that with this stock moving up, by the time the expiration date came, if I sold it at this price, and then the stock, after hitting this bottom, it rises up. Now, if I sold this strike price at around $37, $38, there's a risk of being called out of the stock at this price when I was assigned it at around $49. So the requirement that selling covered calls in a downward trend implies, and that you need to be willing to factor in is that if the stock moves above the strike price of the covered call you've assigned, or the covered call that you've sold at a lower strike price than your purchase price, you should plan to buy that covered call back quickly to minimize the risk of being called out and losing those shares and having to absorb that loss. Otherwise, you can be called out at any point that the stock stages a significant rally. This rally is another example that happened from October through December, where if you're selling covered calls in a downward trend, you could have been called out. And so you have to be willing to act quickly if you're going to apply these kinds of strategies in stocks in these long-term downward trends, especially if part of your core purpose is to continue to receive these dividend distributions for as long as the stock is above your original assignment price, that is up here around 49 in my case. But there are multiple ways you can decide that you want to manage these positions, you want to manage these trades. And my preference and what you will see me do is simply to hold on to these stocks for as long as I believe the fundamentals remain solid, remain strong, and the value proposition is in place. That means that in many cases I may hold on to stocks from a put sale assignment for a year or more. I currently have some stocks that I have been holding for more than 2 years for this reason. But that relies on these basic principles of having the fundamental strength in place, value proposition continuing to be attractive. If there is any element or any indication that those fundamentals are deteriorating in a significant way that is not going to be recoverable. Maybe there are significant management concerns or broader concerns about the company's direction, health, long-term viability that begin to come into play, then that may be a reason to go ahead and recognize a loss. The fortunate thing about these situations is they have been few and far between. Since I began managing the Rebel income system, I've only had to take a handful of these losses, as opposed to a vast, much larger number of successful trades. This is why my success rate in these stocks is at around 97% right now, because the reality is that needing to close out these stocks, even in these lower downward trends, is a very, very rare occurrence. Okay. All right. When it comes to dividends, then, when we're trying to understand the value of dividend distributions, one of the things that becomes important is to understand the difference between fundamental strength in a dividend-paying company, dividend-paying stock, versus an attractive yield. There is a natural tendency to gravitate to stocks that pay the highest possible dividends. And the dividend yield is a simple calculation of the annual dividend payout per share divided by the current stock price. I encourage people to resist the temptation to gravitate to the highest yields possible, simply because those higher yields are often unsustainable. And especially if they represent a large portion of a company's overall profit per year, then it is hard for the company to be able to do anything else than pay dividends. It is hard for them to be able to invest in growth and expansion and to try to do more than simply manage their business. So this is why one of the things that I put a big focus on, not only on dividend yield, but is on the other fundamental metrics like free cash flow, cash, available cash, manageable long-term debt, healthy net income levels, is to try to identify not only whether or not they're able to pay a dividend, but also their ability to sustain a dividend. I contend and I maintain that dividend quality is far better and far more important than higher yield. There isn't a set threshold that I set for how much I want a stock's dividend to be, what level of a dividend yield I try to look for. I simply want to look for stocks that do pay dividends and have a strong, healthy, growing fundamental profile to go along with them. One of the ways that I can evaluate the sustainability of a dividend is very simple. It is by looking at the stock's dividend payout per share and dividing that by the last year's total earnings per share over the last 4 quarters. If, for example, a stock has paid a dividend over the last 4 quarters of $1.50 per share, while their earnings per share are $4.50, then their dividend payout, sorry, let me pull up a calculator just so I can make these numbers visible. So I have a $1.50 dividend compared to $4.50 in annual earnings per share over the last 12 months. That means that the dividend payout is approximately 33% of earnings. On the other hand, if $1.50 in dividend distributions is compared against $2 of earnings over the same period, then you're talking about a dividend payout of 75%. Sometimes you will see dividend payouts that are higher than a company's earnings per share over the last 12 months. Those numbers are very, very difficult, if not impossible, to sustain in the long term, which is why my contention and my primary point of focus is on companies with dividend payouts that are no more than 50%. Lower is more sustainable, and I believe that anything over 50% becomes more difficult to maintain in the long term, and becomes subject to not only dividends being decreased or cut over time, but possibly even eliminated as companies become cash poor and need to try to identify ways to hang on to cash and make resources available to keep their operations running. Okay, that pretty much sums it up as far as the way that I like to look at dividends and some of the reasons that dividends are such an important part of the Rebel income system. Let's talk about our next session, session 8. We're really going to dive some more into covered calls. We'll talk more about using covered calls, why use them. Talk about getting called out and what that means. And we'll talk about the general rules that we like to follow with the Rebel income system around using covered calls on stocks that we have been assigned from our put selling trades. Thanks for your time. I hope this has been useful, and I'll talk to you again next time.